Retail Champs in the month of March. So good to connect with you again. So we'll share the updates on the portfolio companies and overall portfolio in this webinar. Starting with this is one slide, which gives us a lot of confidence, a lot of conviction, a lot of courage actually, irrespective of the macro cycles. So this is that slide which talks about the long-term fundamentals of the Retail Champs companies. As you can see, across different time periods, the fundamentals of the company have remained very robust. Whether we talk about FY 12 to 16 period, where we had more or less a similar conditions as we are witnessing today, rising interest rates, rising inflation, rupee had depreciated to 70 to a dollar in the month of August 2013. Despite that, the median EBITDA for the portfolio, it compounded at 21% per annum. Similarly, going forward to FY16 to FY19, we again had GST, we had demonetization, we had recession in one geography or other. I remember there was a kind of recessionary conditions in China in 2015. Again, one thing remained constant, that the EBITDA compounding for the portfolio continued north of 20%. And in the latest block of last 3 years, we had COVID, pretty much for the last 2 years. And despite that, again, one thing remained constant, that was the EBITDA compounding for the portfolio continued to remain very healthy, near about the 20% mark. So not only on an absolute basis, but when you compare to the broader BSE small cap fundamental performance, the gap has been maintained. So on an average, the portfolio has maintained that gap of anywhere between 7 to 10 percentage point in terms of earnings or EBITDA compounding. So this is where we want to start with. Moving forward to the performance update, the performance of the portfolio is largely tracked that of the BSE small cap benchmark. Whether we talk about the last 1 month, 6 months, or even a longer time period since inception, which next month we will be completing 3 years of LCP, Retail Champs. The performance of the performance is largely tracked the BSE small cap. So some of you may have questions that, in the preceding slide, we showed that the fundamentals of the company, they beat the benchmark fundamentals handsomely, but why on the performance side, we are not able to beat the benchmark? The answer for that is twofold. Obviously, one answer is on the right-hand side table. You can see some of the stocks lower down that table. They are corrected anywhere between 20% to 30%. So that is one reason some of the stocks have seen a bit of drawdown in the last 6 months. And the other reason is that there has been a bunch of stocks in the BSE small cap index, which has done very well in the last 6 months. So you'll find name over here. So typically, if I classify the set of stocks over here, typically the energy companies, the real estate companies, or commodity-based companies, they have done extremely well in the last 6 months. So that has also kind of helped benchmark performance in the last 6 months, or more generally, even in the last 2 years. I think this set of stocks would have done well. So the question is, should we invest in these stocks, which have been doing well in the last 6 months, 12 months, or even last 2 years? Our answer, you must be as expectedly, answer is no. So we will continue to invest in quality small cap compounders in the Retail Champs portfolio. The reason is that we believe in the near term, whether it is 6 months, 1 month, or even 2 years for that matter, the share prices may be tracking more about the news or the noise. But on a long-term basis, the stock price should track the fundamentals. And we are very confident about the fundamentals of the Retail Champs companies, and we will dwell deeper into later on in this presentation. So one is that we believe that structurally, again, we have been highlighting this for quite some time, that the macro changes that are happening in the economy, they favor efficient market leaders. That like Retail Champs. And secondly, we are very convinced and confident about the quality of the portfolio companies, the management of the portfolio companies. And hence, one has to take a longer term time period, say 5 year, 10 year. We think the companies which deliver well on fundamentals, they will end on delivering better on this share price also. Just to give you some data point, for example, if as a basket, I look at the performance of these stocks on a 1 year basis, it may look very good. 2 year basis may look very good. But if I look on a 5 year basis, just to be precise, the median earnings that this basket has returned is close to 15%. And when I look at 10-year share price, median share price return for this set of companies, it is close to 16%. And I'm sure that none of you would be happy investing for a 15% annualized return or a 16% annualized return in a small cap portfolio. So the point is that on a longer term time period, the stocks would track the fundamentals, and that is where we'll continue our focus on continue to invest in a well-run, high quality, clean companies, and this is especially important for the small cap portfolio like Little Champs. And continuing with the fundamental theme, so first is that there have been structural changes in the economy which is happening in the last 10 years, and which we think have been benefiting Little Champs companies and will continue to benefit the earnings of the Little Champs companies in the foreseeable, in the coming years. One is obviously the as a economy, India is much more integrated, getting integrated in the last 10 years. Now we have like a significant expansion of road network. We now have even the airport connectivity for tier 2, tier 3 cities, and it is moving at a rapid pace. Similarly, internet penetration has reached every nook and corner in the Indian economy. So what it does is that it actually helps well-run market leaders to reach even the hinterland, rural hinterland, and the remotest part of the country, which was not possible 15, 20 years back. There were physical barriers to entry for a national player to reach the remotest part of the town, and hence as a result, the smaller players, the unorganized players, the local players, they thrived because of these barriers to entry. But more and more, that barriers are getting broken now, and hence companies like Little Champs, they are able to reach the remotest part of the country. So that is one positive development. Second is that economy as a whole is getting more and more formalized. I think we had demonetization, we had GST, but every step that is taken by the government, it is getting more and more formalized. And this actually raises the cost, compliance cost, etc., for the unorganized players. Again, it actually places the market leaders, well-run companies, at an advantage compared to the unorganized segment, compared to local players. The more and more formalized the economy, it helps the companies like Little Champs. And thirdly, the technology also is now, so 15, 20 years back, technology, when we talk about technology, was more about hardware, very heavy investment. It probably was limited to a very limited company set of companies, maybe Fortune 500 companies, or even in India, probably the top 10, 20 companies. They could have invested in the technology given the ask. But as technology has now migrated more to internet, more to mobile, more to cloud-based, more to SaaS, etc., it's become more and more affordable. Even these smaller companies can, on a modular basis, invest into technology. And this is where Little Champs have done wonderful job of using the technology to bringing a lot of efficiency. Again, I will cover this in a little bit more detail in the coming slides. But the point is, and lastly, but not the least, as counterintuitive it may sound, actually slow down the macro disruptions that have happened in the economy in the last 10 years. I think that actually structurally benefits companies like Little Champs, because as an investment philosophy, the filters which we used for selecting companies, we by default end up investing in the market leaders, even though that market may be niche in the case of Little Champs, but we prefer investing into market leaders rather than investing in a small player in a big market. We invest in a large player in a small market. So what happens in a slowdown or disruption, companies like Little Champs, which have double-digit margin, which have return on capital employed substantially better than the cost of capital, which have surplus cash on their balance sheet, they are able to absorb the near-term pain, 1 or 2 or 3 quarters. But the same is not the case with the peers of these companies who hardly make any margins, maybe mid-single digit, have loads of debt on their balance sheet. For them, it is simply they are not able to survive this near-term disruptions, slowdowns, etc. And hence, these Little Champs companies have benefited. There is enormous market share gains that these companies have seen in the last 10 years. And in fact, as I said, slowdowns actually structurally benefit companies like Little Champs. And this has been one of the important success factor for Little Champs. The last 10 years fundamentals, which I showed, one of the major contributing factors is this set of factors. And the second set of factors is basically the company themselves, the management of the companies. They have consistently reinvested in the business. As you can see in the slide, across different time periods, you will find that the reinvestment rate has remained very healthy. And in FY 18 to 22 period, despite rising cash flows, as these companies are getting bigger, the cash flows are also getting bigger. But still, the momentum of the reinvestment has remained very robust. So, on an average, nearly two-thirds of the internal accruals have been invested, even as the size of these companies getting bigger. It's like akin to, for example, maintaining an strike rate of a T20 batsman, but even in the test, basically 5-day format, maybe strike rate maintain kar rahe ho, of a T20. And the reason why, and ROC again, one pitfall of high investment in a typical company is that your ROC keeps on diluting, but that has not been the case with Natal Champs. So ROC, despite more and more reinvestment, the ROC of the company have remained very, very robust, very stable. And the reason why these reinvestment initiatives for Natal Champs have worked is 2 to 3 reasons. First is that a lot of reinvestment has happened within the business itself. So management have put the money where their expertise lie, where they understand the business. So by default, when you're investing into the core business, where you know the business running for years, for decades, I think the chances of generating healthy return increases. The probability rises. And where these companies have invested is where basically the opportunity that is being thrown by the economy, which I showed in the previous slide, the Natal Champs companies have grabbed it quite nicely. So there is a continuous investment in the products that these companies are making, in expanding the distribution network, expanding the capacities. We have seen a lot of inorganic acquisition in the recent years by the Natal Champs companies. In other words, they are constantly in the pursuit of market share gains. So they are not only expanded their market share, but in the process also edged out their weaker peers. So market share gains, courtesy this investment, there has been a tremendous market share gains these companies have realized. And finally, as I said, as technology becoming more and more accessible, and Natal Champs have invested in this technology. So some of the initiatives are highlighted in the exhibit that is being shown. So not only on the front end side, but even on the back end side, whether it is estimating in better forecasting techniques, better inventory management system, automation of warehousing, etc. So there has been accelerated tech investments in the backend also. And the result of all these steps, investment in products, distribution, acquisitions, capacities, technology, is besides the top line growth, which is quite given, there is also a tremendous or significant improvement in the EBITDA margin of these companies. As you can see in the EBITDA margin column, so progressively, the margins of companies have improved. Again, coming from 3-4 reasons. One is obviously the tech investment, which I highlight. So more and more tech spend. For example, if one were to map the profit per employee of the Natal Champs companies, it would have come down significantly. It would have actually improved. Sorry, profit per employee would have improved significantly. In other words, more and more things are getting done by the companies at a lower and lower labor count. So technology investments has clearly helped. Secondly, as these companies have gained market share and volumes, it also actually helps them get better bargaining from customer as well as the vendors. So you are basically sourcing higher and higher volumes from the vendor. So naturally, your the pricing that you get also benefits. And thirdly, these companies across the board for these companies, we have seen an improvement in the product mix of these companies. So whether I take, for example, any name on this top on this slide, Garware, for example, 10 years back, most of its revenues used to come from fishing nets, which I would say is slightly commoditized product. But now a large part of its revenues come from salmon aquaculture, where clearly, a value, it's a clearly high value added product for Garware. The margins would be significantly higher for in the salmon aquaculture cage that Garware supplies. Similarly, for Alkyl Amines, I would believe more than 10 years back, most of the revenues of Alkyl was coming from basic amines, methyl amines, ethyl amines. But now more than 50% of its revenues come from value-added products like amine derivatives, acetonitrile, which is a specialty chemical, and so on. So across the board, courtesy the investment in the product, the value, the product mix of the companies have seen an improvement, and that is also contributed significantly to EBITDA margin improvement. And these are all structural factors. Basis our belief that the competitive positions of these companies will only improve. These companies will keep on investing in R&D, etc. So there is a structural improvement in the margins we have seen, and we believe it will continue so. And the second positive impact of investing in the business is on the working capital side. So again, as similar factors as margin, as you become more and more dominant, your market share increases. You are able to command better. For example, for the customer, you are able to get faster payment because you are now accounting for more and more share of the business of the customer. Similarly, vendor side, you are now a bigger player. You are able to give them payment at a little bit longer term time period. In other words, you are able to bring down the working capital cycle. And second is because of the investment in the technology, that has also helped crunch down the working capital, particularly the inventory days. Having said that, much of this initiatives improvement is getting masked because of what has happened in the last 2 years because of COVID. For example, in March 22, because of the increase in the commodity prices, input prices, and because there is still supply chain uncertainties surrounding Russia, Ukraine, surrounding the COVID situation in China. So most of the companies loaded up on inventory actually. So you'll find that FY22 May, FY22 column May, there has been an increase in the inventory days. But as situation normalizes, we think the benefits of market share gains, technology investment, that should flow through more prominently for most of the companies. And hence, we are betting big on the working capital improvement for the Little Champs companies. Having said that, even for quite a few of the companies, you'll find that last column, anyways, the working capital has been improving. So you'll find that some figures are marked in blue font. So that indicates that there is a significant improvement in the working capital for these companies. But we believe that as situation normalizes, the working capital should see a more significant fall. And that should, besides margin improvement, the working capital improvement should result in a significant acceleration in the operating cash and free cash flow generation for Little Champs in the coming years. And what these companies, again, one question you may have, and most of you must have raised in the previous session, is that end of the day, these are niche companies which are present in the niche companies. There may be a limit to how much these companies can grow. And if these companies have already reached a high market share, so growth kidhar se aayega? Basically, these companies will be hitting a ceiling limit. The answer to that, how Little Champs have addressed that point, is by two things. So first important growth that these companies are targeted is going into global markets, basically. So use the cash that is generated by the core business and replicate the success that you have got in India at the global level. And happy to tell that more than 50% of the Little Champs companies, non-financials Little Champs companies, they now have sizable exposures of their revenues to the global markets. And when we talk about global market, it is basically India into many times, right? Global is huge market. For example, just to take example of GMF Pfaudler, the global glassline equipment market is nearly 8 to 10x than the glassline equipment market of India, and similar for the other industries. So these companies have, we believe, just got a foothold in the global markets, and there is a long growth runway for the Little Champs in the global markets. And the success of the Little Champs in the global market is not the conventional success of Indian companies surrounding cost, but it is more to do with your products, processes, and people. So on the product side, as I said, like most of the companies have worked on improving the value-added products, getting into more complex products. That has been one important success factor in the global markets. For example, Garware wouldn't have been successful in the salmon aquaculture market had it been only competing on the basis of cost. What Garware did differently was basically come up with solutions for that addresses customers' problems. For example, one big problem in Canada salmon aquaculture market was surrounding the environment, fouling That happens when you apply copper on the cage to clean the algae. So Garware came up with a very unique V2 nets where you don't need to apply the copper solution on the outside. The copper is inbuilt at the time of the manufacturing of the net itself, when it is in the polymerization stage itself, when it is in the molten stage itself. So what that happens is that in this kind of nets, there is a very slow release of the copper ions in the water, and hence so cost has not been the competitive advantage for the company. The key competitive advantage is coming up with the unique solutions. Similarly, GMM folder, again, the success in the global market is not because of cost, but because of the patent and the technology that it owns surrounding glass lining equipment, the material that needs to be applied, the process through which it needs to be applied. And so that has been the key success factor for the Needlechamp's global foray. And second, growth drive, how these companies are addressing the growth concerns surrounding B2B niche is to going into adjacencies. So again, when we talk about diversification, most of the Indian companies have not been successful, primarily because those companies have diversified into businesses which had nothing to do with the core business. So where Needlechamps have done differently, and the reason for the success in the newer businesses, because these newer businesses had something to do with your core businesses. So again, taking the case of Garware Technical Fibers, the salmon aquaculture, again, it's not reinventing the wheel, basically. So end of the day, it is made out of the same material that is used for making the fishing nets, fishing nets, basically. The only thing you have to work on is improving the product quality, improving on the additives that you need to add. So Garware has leveraged the polymer engineering expertise. It always had it built on it. So that is similarly case of GMM folder. The success in the adjacencies like mixing system, heavy engineering is because it has to do with the core industry of GMM folder, which is the pharma and the chemical companies. So GMA was already supplying to these companies. So you leveraging the dominance that it has in the glassline equipment, kind of push these products to the same set of customers. So again, there's nothing to reinvent it. Basically, leverage your customer relationship to push more products. Similar the case with the other companies that is mentioned over here. So one is that it has something to do with your core business, leveraging the core competence you have. And secondly, again, these companies have not put big capital. So have been conscious about the capital, whether it is acquisition or organic acquisition. It has been done very sensibly, but not putting too much capital that, if unsuccessful, can actually blow away your balance sheet. So companies have gone very gradually, very sensibly. So that has also been the reason why these companies have been successful in the product adjacencies. And finally, the third success factor is, and this is particularly important in the small cap companies, that most of, or rather all the Needlechamps companies have been very focused on the listed companies. So by choice, we have not invested into companies where the promoters are into several businesses, because that kind of dilutes your focus on the core business or the listed company. So the Needlechamps companies, the listed company is the whole and soul of the promoters, basically wealth. So that is also reflected in the shareholding that these company, the promoters have in these companies. By the way the remuneration is structured. So for most of the Needlechamps companies, a large part of remuneration is linked to profits. So if the company don't make money, the promoters also don't get salaries. So we like that construct. Similarly, as I showed, the company's cash that is being generated by the company, more and more is put into the company itself to grow the core or build the globalization strategy or get into adjacencies, rather than cashing out through dividends. So promoters have ensured high skin in the game. And last, I already covered. Needlechamps account for the bulk of the wealth of the promoters. And this has been one important success factor. And this is also the reason why these companies, particularly in downturn, they keep on doubling down the investment. It reflects on the conviction of the promoters of this company. And second part, where the software aspect for Needlechamps have worked very well, is the succession part. Again, when a company is small, it is in one geography or one product, it can very well be run by one single leader. But as the companies have shown, have gone into different geographies, have gone into different newer business segment, it would have been successful if it was still continued by one single person. So where Retail Champs have done well is that they have moved towards institutionalization. So bringing in next generation leaders. For example, most of the Retail Champs that we have currently in the portfolio is they are run by second generation leaders actually. So and they have not been parachuted in the company the day one say up chalao. They have been conscious. They have been brought into the company, and they have come to the position by working through the ranks in the company. So in the process, gaining experience in the process. So there is a well thought through grooming of the next generation leaders for most of the Retail Champs companies. Secondly, we are also saw that a lot professionalization of the management team that has happened in the Retail Champs companies. So for example, more than 50% of the Retail Champs companies, there is a CEO who is independent, nothing to do with the promoter family. So that is also a positive development. So there is a adequate thrust on the professionalization that is being taken in the companies. And lastly, we are also seeing consistent improvement in the board quality, particularly the independent board quality in the Retail Champs companies. And this is especially important in small cap companies. There is promoter family members, they are one power structure. So there should be an independent power structure which can question or act as a watchdog in the company. And this improvement in the independent board directors gives us a lot of confidence. So this again, software aspects, which I think the analyst investors don't pay attention, but this is especially important and one of the defining competitive advantage of the Retail Champs companies. And why we believe that Retail Champs are ready to take off is by doing what I highlighted in the previous slides consistently over the last 10 years. Retail Champs have basically turned into a cash machine. For example, the operating cash size of the Retail Champs portfolio is now almost 4x than what they used to make 5-7 years back, courtesy the good things that they have done. Repeating that many times. So, courtesy of this rise in the operating cash, this opens up a lot of opportunities for the Retail Champs companies. So, as I said, like in the global market, even though these companies have done well, but when you look at the market share of these companies, it may be still, as a whole global, it may be very small. So, there is a lot of opportunity to grow in the global markets. There is a lot of adjacencies that can be added even more. For example, Garware, I would say maybe catering to 3 to 4% of the overall polymer market as such. So there's a lot of adjacencies that can be added. And this increased cash flow, operating cash, this actually gives them a lot of firepower to realize these opportunities. And hence, we believe with this snowballing of the operating cash, the companies are very well positioned for the next 3, 5, 10 years to realize these opportunities that are in front of them. And finally, the testimony of that is also reflected in the investment that these companies made in FY22. For example, amidst all the challenges that we saw in FY22, COVID, the second wave really impacting the first quarter of FY22. Similarly, the huge increase in the commodity prices that we saw in FY22. Despite that, despite all that gloom and doom, the company's investment actually, Retail Champs actually ramped up on their investment, whether it is organic or inorganic in FY22. So that kind of shows both the opportunity in the market for consolidation, opportunity in the global market, and secondly, the improved capabilities of these companies reflected in terms of their rising cash flow that these companies are generated. So we are quite positive about the fundamentals of the next for the companies for the next 3, 5, 10 years. In fact, we believe that looking at these figures of investments, capex, acquisitions of the companies that they have made in the last couple of years, we believe that in fact the next 10 years could be even better for the Retail Champs companies in terms of earnings. And one more optionality which can emerge is for the retail champs is right now they are still small in size. As a result, after reinvestment, the free cash flow is a bit low. But as we have seen in the case of Rising Giants portfolio, as these companies crosses this critical threshold of size, we believe more and more free cash flow will also start getting generated for the retail champs companies. So we are looking forward to that also in the coming years for the retail champs portfolio. Maybe I'll stop here and we can start the Q&A session.
So Ashvin, lots of questions coming in. Folks, feel free to put questions in the Q&A box. We'll try to take as many as we can in the next hour or so. Let me start with the question that Ashvin, you must have been asked your entire career, which is, why do you buy stocks with high PE multiples? Ashvin, what's wrong with you? Why do you buy these stocks with high PE multiples?
Yeah, so one is, so we have a different way of looking at valuation rather than the headline PE. For example, for most of, and that applies to most or rather all the retail champs companies, that's why they are into the portfolio. We believe that these companies can compound their earnings for a pretty long period of time. And as I showed, while maintaining, even in history, these companies have compounded earnings at a pretty strong clip, and while maintaining the ROC. So if the future holds similar to these companies, what they have done in the past. So for example, these companies can compound the earnings for the next 15-20 years at similar clip, and they are also able to maintain ROC north of 20%. I think, for example, the retail champs companies currently are trading at 40x. So I think we are deep in the money. So the intrinsic fair value PE for this company should be, if I talk about 15-20 years का compounding, ROC भी maintain करेंगे at 20% से compound करेंगे, should be well north of 100x. So in a way, we believe that actually these companies are pretty cheap actually. So it's not that we don't look at valuation, but we don't look at headline PE. We look at the intrinsic value of the company from a long-term compounding perspective, and then we compare the current market price. So that is how we say. And secondly, again, we believe looking at this slide, there is a lot of non-linearity in the earnings that can come because, for example, global markets these companies are still scratching the surface in terms of the overall market. So the long runway for growth, a lot of non-linearity in free cash flow that I highlighted. If the companies are able to deliver that, I think irrespective of what value you buy, I think the share price should do well.
Folks, several of you are asking whether can you put money in little champs. I'm afraid the answer is no. Ashwin's looking after 900 crores in this portfolio. We're not going to take money into this right now. We'll wait for the next scare. Kuch na kuch to hoga. Somebody will blast a bomb somewhere. Some country will attack some other country. So the next scare jab hoga, then there is the next global scare, macro scare. We might open it up then, much like we did when Putin attacked Ukraine. We opened it up and took, I think, a couple of 100 crores. But at the moment, we're not taking money. It's compounding beautifully for us. But because liquidity is so low in these stocks, every time we open it for flows, it's a real task finding shares in the market, which without ramping up the stock price. So we hope to open it whenever there's the next global scare. But until such time, I'm sorry, we can't take money in this. Ashwin, next question is on GMM Pfaudler. So as people have seen on your slides, and they've heard you speaking about it for 3 years now, it's a stock that you own in large quantities. This portfolio has got a big position in GMM Pfaudler. Anonymous attendee says it's been a clear underperformer. Yet you have one of the highest weights in it. Why does the stock market not like this stock? Anonymous attendees asking you, and how much money do you expect to make in GMM Pfaudler?
Yeah, so on the so if you expand the so clearly it has been underperformed when you look at the last 1 year or maybe 1.5 years. But if you expand the horizon to 3 years, say maybe for example Little Champs ki inception say, it is one of the best performing stocks actually in the portfolio. I think after Alkyl Amines, since inception, GMM Pfaudler would be number 2 or number 3. So again, depends upon what time period you look. Our urge is that you look at a little bit longer term time period. Having said that, on the fundamental side, we are much more convinced on the stock than we were 2 years back. So 2 years back, GMM kya tha? GMM was basically glass-line equipment, one product, and one market, India. But courtesy the acquisitions steps taken by the management in the last 2 years, we are much more convinced about the fundamentals. One is, as I said, like after the acquisition of Folder International, the world is a market for GMM Folder. In other words, there is a 8 to 10x increase in the addressable market, and without paying much actually. After doing this four acquisition, all that the debt equity ratio of GMM has risen is to 0.5x. It's not that they have kind of blown their balance sheet and acquired this. So addressable market has increased significantly. Within India, its market position has improved significantly, courtesy the acquisition of the third largest player, data rich process system. So India में core market में भी आपका market share improve हुआ, world has opened for you. And on the management bandwidth side also, GMF Folder has done very well. They have got a new person to run India, whereas Tarak Patel is focusing more on the global market. So there is an adequate scale up on the management bandwidth also. So fundamentally speaking, we are very quite happy. Hopefully the market, and Aisani GMM Folder has been on the fundamental, even in last 1.5 years, the earnings of GMM Folder has been pretty resilient. There have been some one-offs in the reported numbers because of the integration of Folder International. But when you look at the core earnings number of GMF Folder, on the earnings side also, there is the numbers are being delivered. So hopefully market will also kind of, maybe it's on a holiday period as we highlight. So, but the numbers are clearly coming out for GMF Folder, and the fundamentals are really strengthened in the last 2 years.
Right. So some of you have immediately followed up saying that last time when we opened it for inflows around the Ukraine attack, you didn't hear from us. So folks, if you want to hear from us, you have to register yourself with our sales team. So drop a mail to sales@marcellus.in, sales, SALES at Marcellus, MARCELLUS.in, and say that you'd like to invest in Little Champs. Remember, SEBI rules mean that the minimum subscription is 50 lakhs. Let the sales team know that you want to invest in it, so that next time there's a crisis and the stock market tanks, as it inevitably does because people panic very quickly in our country, when the stock market tanks and we open it for flows, we'll contact you. Secondly, some of you are saying, well, if the stocks are so undervalued, why do we care about a 10 to 15% price impact? I wish there was only a 10 to 15% price impact when Marcellus loads up on these stocks. When we load up on these stocks and the brokers get whiff of it, the stocks rocket 10 to 15% would have been a very happy situation. So because the stocks rocket so quickly upon us, buying say 10, 20 crores of these sorts of stocks, we tend to be very careful about taking incremental flows. Let's carry on further. So Ashvin, some of the more eagle-eyed clients have noticed that barring Suprajit, you don't have any other auto ancs in the portfolio. And the question they're asking is, do you have something against auto ancillaries?
No. So once upon a time, actually, we had 4 auto ancillary stocks in the portfolio. I think the question at that time used to be why we have 4 auto ancs in the in the portfolio. So again, the reason for exiting some of the stocks are one is obviously we keep on monitoring the portfolio companies very closely. So again, all I highlighted mostly on the track record of these companies, fundamental track record. Doesn't mean that we get complacent. If the past is good, we keep on keeping a very close tab on is the management getting lethargic or anything else. So one is that portfolio companies, we keep on doing more work. And as we do more work, there is a set of stocks which see upgrades. And again, Little Champs currently has 16 stocks, but there is a set of other stocks we keep on working. So as we keep on working, there is a set of stocks which see an upgrade. There is a set of stocks which see a downgrade. So the point is that the best 15, 16 companies from that scoring perspective will remain in the portfolio. So again, the reason for exiting those stocks where we took a relative call that maybe a Tarsans could add more value to the portfolio than say an auto ancillary names. So on a relative basis, the new entrants have edged out those auto ancillary companies. Also, one maybe our understanding has also evolved. For example, one company in auto ancillary which we used to own, where there's a huge customer concentration. And unfortunately for that company, that customer actually saw a huge decline in demand in India. So there is also a lesson for us actually. So now we are much more kind of aware, and we typically invest in companies where there is more customer diversification. So yeah, so that is the answer. Nothing to do with the sector per se, but it's more about whether it fits in the best 15, 16 stocks in the portfolio from a return, from a earnings return perspective.
Ashwin, there seems to be some confusion amongst people who are listening. They think an anonymous attendee is saying reinvestment rate means retention rate, right? So can you just clarify to people what investment rate is and why it's such a important metric for discerning investors?
Yeah. So reinvestment is different from retention, because when you say about retention, it is purely whatever you're not given out as a dividend, that is retention. But the problem is that if that money is retained as a treasury, so then basically it's a return dilutive for the shareholders, right? There are many companies where you find balance sheet may bahut sara cash hai. It's almost more than even net worth for that cash. So it's a suboptimal capital allocation. When we talk about reinvestment in this presentation, we are talking about how much of your operating cash is getting invested into capex and strategic investments. We are not talking about treasury investment, but strategic investment means you are acquiring some company, etc. So that is very important, because any company which stops reinvesting, it's kind of आपका 2-3 साल के बाद growth taper down होने लग जाएगा, because right, you have to constantly, just like you need fuel to run the car. If you stop putting petrol in the car, it will stop. It may run for some distance and then stop. But so you have to constantly reinvest in the business to gain market share or build new growth drivers. Constantly do capex and constantly do acquisition, unless there are a couple of exceptions. So, for example, Amritanjan in our portfolio, some of you may notice that reinvestment rate is low. The reason ऐसा नहीं है कि Amritanjan has stopped growing, but they have adopted a different model. So, for example, for the foray into sanitary napkins, they have gone on for an outsourced model. So there may be some exceptions to this rule, but generally speaking, a company which stops reinvesting will very soon see tapering of the growth rates.
So 2 questions on intangibles, actually 2 very well thought through questions from different clients or attendees on intangibles. So firstly, Ashwin, Nirav Hemani is saying that, look, Nirav has, I guess, been following our research. He says CCP companies, consistent compounders, have demonstrated a history of building an institutional, which means CCPs, Nirav is saying, CCPs have well laid out process around succession planning, professional management, incentive structures, so on and so forth, right? So Nirav is asking, how do you assess, Ashwin, that the little champ companies are also on their way towards building an institution?
Yeah. So we more or less use the same factor. Maybe I'll go to that slide again. Yeah, so same set of factors. So for example, but some differentiation would be, so end of the day, the family members would be running the show. So for Little Champs family run business, we also look at कि family level पे succession कैसे हो रहा है, मतलब. So because that could be a recipe for disaster. If for example, the second generation or next generation, there is an acrimony amongst that members, it is very well likely that that company will kind of blown to pieces. So as that dispute increases, so we look at that family level पे आपका succession कैसे हो रहा है. So that is one maybe differentiation we do in the Little Champs. But otherwise, from a board perspective, we look at the same parameters. Independent board of directors, are they truly independent, or just by designation they are independent? For example, one of the best ways to assess that is look at the other directorships of the independent directors. If they are, for example, sitting, and you'll find that in many small caps, the independent directors would also be sitting in the board of the privately owned companies of the promoters. That is a clear sign that these are not independent in true sense. So that is, and then look at the professional management team. Again, इसमें एक differentiation है कि again, because there are family members, it may be very well possible that management team may be dominated by the family members. If they are well qualified, well experienced, it's good, right? It's nothing that वो बाहर से आना चाहिए. If the family members are well qualified, experienced, I think very well the management team may be dominated by the family members. But it should not be because of just relations. You should be on the management team. It should be more about your qualification and experience, that you should be on the management team. The only leeway we give is that CCP, you can expect that because these companies have been running on for decades, you have like you maybe little bit, maybe we can compromise because these companies are still on their evolution phase. You can't expect them to be having like CCP type institutionalization, but at least whether there is an intent and at least the journey has begun. So I think that will be good enough for the retail gems portfolio. They need not be 100% on institutionalization, but at least 10-15-20% का journey start किया है. I think that will give us a conviction that they are on the right path.
Now, Ashvin, so technical question comes from Rupam Dev in Singapore. So Rupam is asking that for the businesses that have been making acquisitions, the ROCE that we are showing, right? Does that include in the denominator the goodwill? Is it including goodwill in the denominator or excluding goodwill?
Yeah, so it is including. So capital employed, we have taken everything, including cash. Probably we may have just reduced deferred tax liability. Otherwise, सब कुछ लिया है capital employed में. And the reason why goodwill, honestly, is a very good question. Just strike me that goodwill is not big for the retail gems companies. One is that अगर रहेगा तो भी, because these companies take very measured capital allocation. So I think most of the reason why historically the Indian inorganic acquisition in the Indian corporates have not worked is that the sizes have been huge for the balance sheet of the company. So in that way, retail gems have taken very measured bet. For example, Suprajit ka bhi, none of the acquisitions have been more than 300 crores. So it has been very sensible in terms of the size. Secondly, these companies don't participate in an auction type acquisitions. So as I said, like there is a lot of consolidation is happening. That is because of slowdown, because of the disruption, etc. Naturally, the price that these companies also pay, it's quite reasonable. So in that case, the amount of goodwill itself generation will be very small because most of the acquisition prices will be very close to the book value of the assets that you are acquiring. So goodwill itself will be a very small component of the purchase consideration.
So, folks, lots of you are asking for people less than 50 lakhs, what is the way forward? As I've said, the SEBI rule is very clear. We can't take clients with less than 50 lakhs. However, we are trying to see within the context of Indian law, within the context of what is permissible in our country, what can we do for those of you who don't have 50 lakhs? It's something that our compliance and legal people are working on. Watch this space. Maybe we can find a solution for those of you who don't have 50 lakhs to invest with us. We would love to come up with a solution, but we also have to focus on being compliant with a very strict regulator. Now, here comes a question from an anonymous attendee, Ashvin, that you have faced before, but no harm in us clarifying this point again. So, uniquely amongst Indian PMS providers, Marcellus has a separate large cap product, CCP, mid cap product, Rising Giants, and the small cap product, LCP. Why don't we do what other PMSs do, which is blend the whole thing and show better numbers, a larger portfolio, and so on? So what's the problem, Ashwin? Why don't we blend this and CCP and come up with an all cap portfolio?
Yeah, so maybe I'll try to attempt. Saurabh, you can add on. So one is that obviously we think every product has its own return and risk characteristics. So it's not doubting the quality of the companies, but for reasons like liquidity, etc., retail gems ka volatility will be significantly higher than say CCP, where the liquidity is good, track record acha hai. So every product has a different risk and reward characteristics. If you are blending that, I think we want a client or an investor to take product as per his or her the risk appetite, the volatility. For example, retail gems portfolio also it did better than benchmark in the COVID first wave, but in terms of absolute fall, it was higher than that of the CCP. So an investor who doesn't like volatility, but is happy with let's say 18-20% return, I think why should we forcefully give volatility to that kind of investors? So this kind of approach helps basically investors to take the products as per his or her return risk appetite, basically. So that is how I will try to put it. Saurabh, you're on.
Yeah, Sri Anantha is asking, sorry guys. Sri Anantha is asking, do you hedge the portfolio? No, Sri Anantha, no FNO, no derivatives, straightforward. You buy the stock, you sit patiently, and you make money, right? Simple, simple, simple forever, right? So no hedging, shedging. Vatsal is saying, I already have a portfolio of more than 50 lakhs. Can I transfer the same to you, or do I have to sell everything and then give it to you? So Vatsal, if you do want to become a client, write to sales@marcellus.in. Say that you want to become a client. And I presume what you're getting at is you want to use the current portfolio that you have to become a client. Don't sell anything. Our sales team will help you do a stock transfer. We can get you, in case we need to sell your stocks, suppose your stocks and ours don't align. If we need to sell your stocks, we can get you a far better exit rate than you can on yours by yourself. And we'll also get you a far better brokerage rate than you can by yourself. So those of you who want to become clients, and rather than giving us money, you want to transfer, you want to give us stock, don't sell the stock yourself. You're far better off getting our traders who do a fairly large volume of trading in the Indian market. Our traders can get you a better price on your exit and get you a far lower brokerage rate than you will obtain by yourself in the Indian market. So sales@marcellus.in, that's the number to contact in case you want to become a client or you want to register your interest with us, so that when we open Little Champs the next time, you can put money in. CCP, the large cap product, is open for inflows. Rising Giants, the mid cap product, is open for inflows. And Kings of Capital, the financials product, is open for inflows. Only LCP, Little Champs, is shut for inflows. So Ashvin, we come now to your favorite question. Why do you underperform, Ashvin? 1 year you underperformed, 2 years you underperformed. Why does this portfolio underperform?
So obviously the history of the portfolio is not long, unfortunately. But the reason why, specifically in the last 1 and 2 years, we underperform, it's primarily because of we are not present in this set of stocks, so which have done well in the last 2 years. Because for example, as I said, like these companies would have given a median return of 15% in the last 5 years. In other words, all the returns these companies have done well, come through in the last 1-2 years. 3 साल में काफी loss, basically. These companies have definitely made huge losses in the preceding 3 years. So we aim for companies which deliver consistent returns. And for this set of companies, I think timing will matter. So it's timing will matter a lot. So I would say on an absolute basis, we have met our target. So when you look at the since inception figures for Little Champs, when you look at the 3-year period, in fact, if I add to July's number, we are very close to 30, slightly more than 30%. So on the absolute, I would say we are on the target. On the relative basis is because of the nature of the market we have seen in the last 2 years. The stock which had fallen the most before 2 years, that have run up the most in the last 2 years. So my request would be to consider a little bit longer term time period for comparing the relative performance.
Folks, one other way to think about it is, as Ashvin showed you, we've invested in 15 stocks. If you look at their free cash flow compounding over the last 3 years, and indeed at the earnings compounding, it's between 25 to 30% in the 3 years that this portfolio has existed. This portfolio was launched in August 2019, so we'll complete 3 months next year. The portfolio complete 3 years next month, and the compounding has exactly been in line with the growth in fundamentals. So fundamentals up 30. If I take the latest number, not the number that Ashvin is showing on the screen, we're up 30. Fundamentals are up 30. We're very happy with that. That's the job of a fund manager, to invest in companies which compound, where the fundamentals compound at a good rate and your money compounds at a good rate. What the index does really is no concern of ours. So anybody sort of listening, you're one of those people who keeps comparing with benchmark and alpha shalfa. We're not the house for you. Go somewhere else. If you want to chase the market, we're not interested in chasing the market. If any of us bought, I should go to that top of the pops chart again, the hottest stocks of the last 12 months. If any of us bought, petroleum stocks and refinery stocks and mining stocks and real estate developers and sugar stocks, I think I would shut down Marcellus. We would go off and retire in the Himalayas. rather than buying metal stocks and petroleum stocks and fertilizer stocks and so on and so forth, right? There are other people who like doing it. We don't like doing that. We like investing in clean promoters with a great track record of good capital allocation and with dominant franchises. Ashwin showed you the names of the stocks in the portfolio. Those promoters do just that. They compound for themselves and for us at a great rate. We're very happy with that. We don't lose any sleep about 1 year, 2 year underperformance and so on. So let's carry on. So Ashwin, Ankit Bisani asks, right? He says he's a follower of Marcellus. He's perplexed. Why are you so transparent with all the stocks? What is the point of telling the whole world what you bought?
So this is something which we have followed for day one. I think we have been transparent with our portfolio companies. We explain our thought process. So idea is to again build the conviction of our clients, build the trust of our clients. So I would say that. Having said that, I think we don't disclose unless you are a client. We will not get to know the weightages of the stock, that we kind of don't disclose it to the larger world. But we think it helps build trust, it helps build conviction. We are not just talking anything, but we are actually showing the numbers, actually showing the portfolio stocks, actually talking about them. So fully, I think it's appreciated.
Okay, so some of you are sort of taking the point further. So some people are perplexed why we are showing the stocks, and Ashwin just explained why we show the stocks for transparency. Others are questioning why we don't offer this on brokerage platforms. So folks, just look at the legal situation very carefully, right? I'm not going to tell you more. If you are doing stuff which is close to the edge of what the law allows, this country will catch up with you. We are actively involved in helping the regulator frame better rules and regs. We also have obviously a compliance and legal department. And as I said earlier, we're looking at the legal situation carefully. If you have read the newspapers recently, you've seen adverse legal developments for those who try to offer portfolios without doing the right amount of legal structuring for the mass investor. So there's a certain way the regulator is operating. The mutual fund is the main mass market product. PMS is supposed to be a product for high net worth people. And if you try to fuzzy the lines without doing appropriate regulatory work, you or I, or whoever does it, fuzzies the lines, will get into trouble. So be careful. If you're doing stuff which is close to the wind, the law could catch up with you in India. Right. So let's carry on. Suprajit Ashvin, right? You had the portfolio, you had the stock in your portfolio for a long time now. You're saying they're generating cash flow, reinvesting cash flows. Why isn't the share price moving up?
Yeah. So again, Suprajit, if you take a little bit longer term time period, so I think it's one of the better performing from a return perspective in the Little Gems portfolio. So I think it has kind of doubled in the last 2.5 years. The reason why Suprajit could have done better is again the auto cycle has been through a persistent downturn, and again last year also kind of unfortunate for the industry in terms of we saw an unprecedented increase in the raw material prices, which we had never seen in the history. And secondly, semiconductor issue came out of the blue. Semiconductor issues hit the industry. Having said that, we are seeing now normalization of the kind of, I think, semiconductor issues are in a much better situation we are compared to what it was 6 months back, and also with the commodity prices stabilizing or in fact declining sharply in the last 2 to 3 months. I think auto sector should see a normalcy. And that should help Suprajit. And even in the context of the overall auto slowdown, for example, FY22 volumes were down almost 30% compared to FY19 levels. In that backdrop also, Suprajit has been able to deliver 10 to 12% earnings growth, even despite this sharp slowdown in the underlying auto industry. That goes on to show the strength of the companies, not only core franchise of cables, but also the capital allocation decisions that the companies have made in acquiring the halogen lamps business, in acquiring the non-auto cables, So that has helped Suprajit significantly mitigate the overall slowdown in the auto sector. And as the sector normalizes, we think the earnings of the company should also come back strongly. I think the recent last 2 days and back, there was an announcement regarding the margin issue in the recently acquired Kongsberg plant. Again, we think it's a near-term issue. Europe is going through a lot of challenge in terms of energy cost, etc. But इसमें भी हम लोग को एक सिल्वर लाइनिंग दिख रहा है कि because Suprajit is a strong franchise, I think they will be able to survive. They will be able to sustain their vendor ecosystem, etc. But the same is not the case with their peers. And hence, going to that first discussion, we think structurally this should benefit. This issue in the Europe should benefit Suprajit because in terms of market share gains. And at the end of the day, Kongsberg is not more than 15% of the overall profit of Suprajit. So it shouldn't significantly, 1 or 2 quarters of kind of margin issues Kongsberg shouldn't materially impact the earnings of Suprajit.
Okay. So I think there was a question on the Rising Giants. What's the minimum? It's a crore, folks. Rising Giants is a crore minimum. Little Champs is 50 lakhs, but at the moment we are not taking Little Champs flows. We are taking Rising Giants flows where the where the minimum is 1 crore. So Ashwin got a very interesting question from Ravi. He says, I have historically dealt with some small caps, some mid caps, some micro cap promoters. He's a banker. He's dealt with these small mid cap companies as a banker. He says that that family run businesses obviously are family heavy on the management front. However, one very sore point in my experience is the poor level of compliance and disclosures for such companies. And in quite a few of them, the banks who had lent them money have taken a write down. So Ravi is asking, how do the constituent companies and Little Champs score on these counts? What checks do you employ to make sure that these firms are good on governance and compliance?
So in fact, it's a starting point for our, if any company is, even if we have a slightest of the doubt on the governance side, I think the stocks will not be part of the portfolio. So the portfolio filtration has rigorous checks on forensic. And we have talked about it again. Quickly, I will just summarize. One is that we apply set of 12 accounting ratios, well covered in our books. So you can refer diamonds in the dust for the 12 ratios that we use. So that is one level of check. So companies which fall in the bottom 40% of that forensic model, we don't invest, we don't touch that companies, no further work on that companies. Second level check is that the companies which clear our quant filters, narrow set of companies, 40-50 companies, they are again subject to extensive annual report reading. We look very closely at the related party transaction, look very closely at other accounting aspects very minutely. And this is not just 1 or 2 years annual report. We're talking about 15-20 years annual reports. Even if there has been one instance in the past where something has been done adverse to minority shareholders, again, that company we will not go further. And then obviously we do a lot of primary data checks and surrounding not only understanding the competitive advantage and business model, but especially in the small cap portfolio, a lot of our primary data focus is also checking the integrity of the promoters. So udhar bhi third level check karte hai. We visit the factories, we visit the branch for while diligencing the financial company. So these companies are after going through that layers and layers of forensic due diligence. Having said that, again, we closely every year the company's annual reports come out. We very closely for the portfolio companies, we closely read the annual reports. Even if there is one like anything we can't understand, some dialogue and some numbers in the financials, we don't understand. We approach the management, but if we don't get conviction on the replies, so we may as well get out of the portfolio. So I think, yeah. So.
Excellent. So folks, Ashvin Shetty is too modest to tell you, he is a master of forensics. He's been doing this with us for 12 years. Before this, he was a chartered accountant at the Big Four. And there's hardly any promoter in India who's looting money, who's inside out of his annual reports. Ashvin won't know. And trained by Ashvin, trained by our fund managers, we have a team of now 18 ACE chartered accountants, and a big part of our lives hinge around making sure that these people don't steal your money. And that's one of the reasons why when sugar companies and metal companies and fertilizer companies and oil refinery companies, they do very well. We don't get that excited because we've read their accounts a few times. So Ashvin, Gladwin D'Souza asks her a question that you love. In your DCF analysis of Little Champs companies, what discount rate would you take? And if you were to do a DCF analysis of CCP companies, what discount rate would you take? He's saying assume a 10-year, let's assume even more chatted, let's assume a 20-year DCF. How much would the discount rate vary between CCP and Little Champs? Gladwin D'Souza broadly is getting at. Lovely question.
Very difficult to answer. So currently we take the same rates. So again, ideally, I think your question is relevant if there is a difference in the quality of the companies. So we are talking about the same kind of quality of the companies. Secondly, again, typically small cap mein kya hota hai ki, again, your question is relevant from a small cap perspective because small caps carry a lot of debt. For example, the balance sheet is very levered. So there is a lot of risk in a typical small cap, and that higher discount rate is warranted. Where the business model is not established, cyclical hai, balance sheet mein debt hai. But in case of Little Champs, I would say from a qualitative perspective, except the size, from a qualitative perspective, they are more or less in in terms of in line with that of the consistent compounders. Obviously, with a little bit with a shorter term historical time record, but we think from a quality perspective that is not much differentiation. And hence, currently we are using the same rates.
Okay, I think we're getting towards the end of the questions. I think let's take one more stock specific and then we'll wind up. Alkyl Amines, the fundamentals look wonderful, right? ROCEs are good, cash flows are good, reinvestment is good. Why has the stock price corrected over the last 12 months or so?
That is because of so this is because of simply this chart actually. So the key raw materials for so when you look at that gray bar, acetic acid, methanol, orange, that is primarily because of the significant so two reasons. One is obviously the significant shoot up in the raw material prices for alkyl amines. For example, acetic acid is a very important raw material for acetonitrile, which is one of the important products for alkyl. So ऐसा नहीं है कि alkyl के पास pricing power नहीं है. So it's actually a duopoly industry. Only alkyl and Balaji are there in the industry. They have a pricing power. Historically, alkyl's margin have been fairly consistent. If you look at FY11 से लेके FY19, fairly consistent gross margin around 50 to 54% market. But last year was different because of the sudden spike in the commodity prices. So acetic acid prices went up by 3x. And whenever there is a sudden spike in a very short period, it will impact on your quarterly results because there is a time lag involved in passing on this to your end customers. So that is the key reason. So I think second half of FY22 for alkyl amines was from a margin perspective, we saw kind of a steep decline. But going forward with the prices stabilizing or in fact dropping, we think that the margins for alkyl amines should see an improvement. So there is no structural reason. This is just that 1-2 quarters may, because of the sudden spike, the quarterly numbers kind of came in bad. And second reason was there was a shortage of so alkyl has a one key product called DMA-HCl, which is used in metmorphin. And alongside DMA-HCl, there is an intermediary from China, DCDA, which is used in metmorphin. Last year, there was a shortage of that intermediary from China because of the COVID situation and other reasons. So as a result, DMA production took a hit for alkyl amines because the intermediate was not available for metmorphin. And again, as the situation in China is stabilizing, I think on that front also, FY23 should be much better. Having said that, the big picture in alkyl amines is this one. So alkyl is to generate, say, FY13 to 15 May on an average basis annual 40 crores ka cash. Now they are generating 250 crores of cash, and this actually opens up immense possibilities for alkyl amines. historically, because of the small size, they have been constrained to one specific chemistry, amines related. But with now 200 to 50 crores of cash coming in, operating cash generation, it opens up a whole range of opportunities within the pharma intermediates chain. So I think we are quite gung-ho about the prospects for the company. Leaving aside 1 or 2 quarters margin hit, I think structurally the company is very well placed.
Excellent. Folks, there's lots also questions from you guys on stocks which are not related to this portfolio. So Page, Asian Paints, etc. We'd love to answer those, but for that, that's the CCP webinar that Rakshit will do. For now, thank you for joining the Little Champs webinar. Have a good evening, and thank you very much, Ashvin. Thanks, Pooja.
Thank you. Thank you.
Thank you all.